Welcome. This is video 3 on policy values. In this video, we will investigate the recursive calculation of policy values. Let us start with example 7.5. We consider the contract with benefit cash flows, an endowment on a person of age 50 for a duration of 20 years with a payment at death or upon survival of amount S. The premiums are paid by an annuity for 20 years. As long as the insured is alive, there is a yearly premium to be paid of amount P. The question that we want to answer now is, let us determine a backward recursion for the policy values Vt for all values of interest. T is 0, 1 to 20. A backward recursion means that we will start from the policy value at time 20 and from that derive the policy value at time 19. If we have the policy value at time 19, we will derive the policy value at time 18 and so on. So in a backward way. We assume that the policy values are determined with a fixed policy value basis, which may be different from the premium basis. Let us start with the policy value V20. The policy value at time 20, the insured is still alive at time 20 if we calculate its policy value, and then we need immediately an amount as the survival benefit. So V20 is S. Let us now go back 1 year and sit at time 19. The policy value at time 19 is by definition the actuarial value of future benefits minus the actuarial value of future premiums, or in this case, it is S times V, because we have to pay S in any case, whether the insured dies or survives. So the actuarial value of future benefits is S times V, and there is only one premium to be paid, namely the premium at time 19, so minus P. So we can rewrite this equation here a little bit, and we get V19 plus P accumulated by interest is equal to S. What is now the interpretation of this recursion? We have arrived at time 19, the insured is still alive, and the following equality then must hold for each policy that is in force. So in particular, for the one where the insured is alive, we need that the available assets at time 20 minus must be equal to the required assets at time 20 minus. What will be the available assets at time 20 minus? Well, at time 19, we have V19. That's the policy value before premium payment. So there is a premium added of amount P at time 19. And this total amount accumulates by interest and becomes V19 plus P multiplied by 1 plus I. So the left-hand side of this equation is the available assets that we will have at time 20 minus just before benefit payment. What are now the required assets at time 20 minus? Well, at time 20 minus, we need a payment of S. So again, this equation, the recursion here, between the policy value at time 19 and the policy value at time 20 is an equality to an equality between the available assets at time 20 minus and the required assets. Let us now, for this same example, look at the policy values Vt at earlier times 18, 17, and so on. So Vt is now by definition the actuarial value of future benefits minus the actuarial value of future premiums. At time t, the insured assumed to be still alive has age 50 plus t, and the actuarial value of his future benefits are an endowment for 20 minus t years of amount S. Concerning the actuarial value of future premiums, well, the premiums are still payable the first 20 minus t years because the insured now has age 50 plus t. So minus P A double dot 50 plus t 20 minus t is the actuarial value of future benefits. This recursion can be rewritten, and for a proof of that, have a look at in the book at page 232. We can rewrite this formula here in the following way. Vt plus P multiplied by 1 plus I is equal to S times Q plus Vt plus 1 times P. What is now the interpretation of equation 7.4? Well, the equation is in fact the same as the interpretation that we made on the previous slide. Suppose that we have arrived at time t and that the policy is still in force. What is needed to hold in 1 year at time t plus 1 minus? We want that what will be available, the available assets at time t plus 1 minus, must be equal to the required assets at time t plus 1 minus, or to be more complete, must be equal at the expected required assets at time t plus 1 minus. What are the available assets at time t plus 1 minus? This is the left-hand side of this equation. Indeed, at time t we have Vt, then a premium is added, and this is accumulated by interest I. So the left-hand side of 7.4 is what will be available at time t plus 1 minus. What is the expected value of what we require at time t plus 1 minus? Well, for all the people who die, for all the insureds who die, we need S. For all the insureds who survive, we need the assets Vt plus 1 to set aside the assets Vt plus 1. So we have Q50 plus T, that's the probability that the person of age 50 plus T dies, multiplied by the death benefit S, plus P50 plus T, that's the probability that the 50 plus T year old person survives, multiplied by Vt plus 1, namely the policy value that we have to set aside. So 7.4 can be interpreted as follows. The available assets seen from time t, the available assets at time t plus 1 minus, must be equal to the expected required assets at time t plus 1 minus. So for the same example 7.5, let us have a look what happens in the last years, the policy values at time 18, 19 and 20. 20 is the time that the policy expires. Well, at any time, let us for instance have a look at V18 here is this value, and that's the policy value V18 before premium payment. Then just after time 18, there is a jump upwards of this policy value because there is a premium P, and again during the year the policy value increases. Here we have arrived at time 19. Again, there is a jump upwards because of a premium payment P, and the policy value grows again over the year. And then at time 20, we have a policy value which is exactly equal to S, the amount that is needed for all the people, for all the insureds who survive. And just after time 20, the policy value jumps to value 0 and the policy is finished. Well, what happens? We want to have a look a little bit at the increasing and decreasing effects of the policy value. Therefore, we rewrite 7.4 a little bit, and we find that the policy value at time 19 can be expressed as a function of the policy value at time 18 plus a premium minus the cost of a 1-year term insurance, and this whole thing multiplied by an accumulation factor, an actuarial accumulation factor. So going from policy value V18, this one, to policy value V19, here, this one. So we compare these 2 points in the curve. We have this expression, and we see that there is an increasing effect due to the premium. There is a premium paid here. There is a decreasing effect due to the fact that there is a death benefit to be paid to the insurers who die. And then there is an increasing effect due to the actuarial accumulation. It accumulates by interest, but it's an actuarial accumulation which goes faster than a pure financial valuation. Next example is example 7.6. We consider the contract that we have considered already a couple of times. There is a deferred annuity on a person of age 50, and the annuity pays an amount of 10,000 starting at the age 60. There is a premium refund guarantee. So if the insured dies before the annuity payment starts, all the premiums that he has paid will be refunded, and the premiums are paid indeed for 10 years, so between the age 50 and the age 60, provided the insured is alive. And we assume that assume that we have calculated the premium with the premium basis, and this premium is equal to 11,900. The question now is, let us determine the backward recursion for the gross policy value VT. The difference with the previous exercise, there we looked at the net policy value, now we look at the gross policy value. We have to assume a policy value basis, so we assume that the interest is 5%. We use the standard select survival model, and as before, the expenses are as follows. There is a 10% of the premium expense in the first year and 5% of the premiums in all the other premium payment years. There is a expense of 100 if the death benefit is paid, and there is an expense of 25 for any annuity payment. Let us start here now the policy value at time 10. That's not the end of the contract, of course. Time 10 is just the moment that the benefit payments, the annuity payments start. The policy value basis at time 10 is actuarial value of future benefits and related expenses minus actuarial value of premiums minus related expenses. But there are no premiums to be paid anymore from time 10 on, so we only have to look at the actuarial value of the benefits and related expenses. So this is a lifelong annuity on a person of age 60. The benefit payment, the annuity payment, rather, is 10,000, and there is an expense of 25. Now we have to be a little bit careful about, do we have to include the annuity payment at age 60, yes or no? This is by convention the policy value after benefit payments. So the annuity payment of 10,000 being paid at time 10 has occurred already, has just occurred, let's say, 1 second ago. So therefore, the policy value basis at time 10 is the actuarial value of future benefits is 10,025, A60, where we use an annuity. The annuity, again, the payment of 10,025 has occurred just 1 second ago. Let us then have a look at the policy value at time 9. By definition, the policy value at time 9 is the actuarial value of future benefits minus the actuarial value of future premiums and corrected for related expenses. So this first part in the equation is in fact the actuarial value of the death benefit. Indeed, if the person of age 59 dies in the next year, he gets 10 premiums paid and there is an expense of 100. Then we have the actuarial value of the future annuity payments. That's an annuity on a person of age 59 that starts in 1 year, and the payment is 10,000 plus related expense 25. And then we have to withdraw all the premiums that still have to be paid. The actuarial value is 0.95p because there is only one premium to be paid and there is an expense of 5% related to that premium. Then you can, from this expression, reshuffling a little bit, you get this recursion. How can we derive that? How can we find this recursion? This is explained in the next slide. Please have a look at it carefully, but it's a simple exercise to see that indeed we can express V9, the policy value at time 9, as a function of the policy value at time 10. Let us go back to the previous slide. Then we find this recursion. And the interpretation is again the same. If we have arrived at time 9, the following equality must hold for each policy in force. What will be available at time 10 minus must be equal to what will be required at time 10 minus, or what is required in expectation. So let us have a look at available assets. The available assets at time 10 minus 1 will be given by the left-hand side of this recursion. Indeed, at time 9, we have V9 for each policy in force. Then there is a premium payment P minus a cost of 5% of the premium. And this total amount is accumulated by interest I. That So the left-hand side is what will be available at time 10. What is the expected value of what we require at time 10 minus? It's the probability that the person of age 59 dies. If that happens, we have to pay 10p plus an expense of 100 plus the probability that in 59 years old person survives. Then, if that happens, we have to pay 10,025. That's the annuity payment plus the related expense. And we have to set aside the policy value V10. So the right-hand side is indeed the expected required assets at time 10 minus. Important is that it is at time 10 minus, so that means the 10,025, that's the benefit to be paid at time 10, has not occurred yet. So we still have to pay that 10,025 in a second, let's say. Therefore, we have here the 10,025 included, and then this is the policy value at time 10 after the benefit payment. Let us then have a look in a similar way at the policy values of this deferred annuity at the times t is 8, 7 until 1. We have a look at the definition of the policy value. VT is the actuarial value of future death benefits, that is expressed here, plus the actuarial value of the future annuity payments, minus the actuarial value of the premium payments. Of course, all these actuarial values corrected for the related premium, the related expenses paid. From this recursion, if we have a look in the book at page 233, we can define, from this definition, we can define the following recursion. And this is again the same, has the same interpretation as before. What will be available at time t plus 1 minus must be equal to what is in expectation required at time t plus 1 minus. Indeed, VT plus 95% of the premium accumulated by interest, the left-hand side is what will be available, is what we will need. The probability that the insured dies in the coming year, then we have to pay the premiums t plus 1, p plus 100, plus the probability that the insured survives, then we need VT plus 1. That is recursion. This formula is formula 7.5. A small remark, recursion 7.5 for t is 9 is not correct in the book. We have the correct expression for recursion 7.5 in case of, in the case the time is time 9 is the one that we have derived in the previous, on the previous slide. And then we have to look at the policy value V0 at time 0. Well, the policy value V0 is actuarial value of future benefits minus actuarial value of future premiums. And we can derive the following recursion from this. This recursion here is very similar to the recursion here. The only difference is that with the first premium payment, there is an expense of 10% of the premium. Therefore, we have here plus 0.9p, while here we have 0.95p, because after time 0, the expense related to each premium payment is only 5% instead of the 10% here. In the same example 7.6, let us have a look what happens now with the policy values, how do they move over time if we come closer here to time 10. Well, the policy value at time 9 is given by this value. Then there is a jump upwards just after time 9 because there is a premium P added minus a cost of 5%, so there is 0.95 P added. Then the policy value increases, and then we are at time 10. At time 10, the policy value drops down with an amount of 10,025 because of the first annuity payment. The policy value at time 10 is this value and not this value, because the policy value is by convention always calculated after after payment of the benefits. What happens then at time 10? The policy value increases again over the year, and then again at time 11 there is a jump downwards because of the 10,025 annuity payment. From 7.5, we can derive the following relation between V9 and V8. V9 is equal to V8, which is then increased because of the premium payment, which is then decreased because there is a death benefit payment, and this whole expression between brackets is accumulated by the actuarial accumulation factor, which goes faster than pure accumulation by interest. If we have a look at the policy value at time 10, we have a similar, from the recursion for V9, we find that V10 is V9 plus the premium payment minus the cost for the premium guarantee accumulated by interest, but then be aware, the policy value at time 10 is the policy value after survival benefit payment. And there is a survival benefit payment at time 10, namely 10,000 and related expense 25. So V10 is this whole expression minus 10,025. So if you look here, V10 is the minus 10,025 is just this jump downwards. Let us now have a look at recursive formula for policy values, but where we consider a fairly general contract. Let us assume that the death benefits Sj and the related expenses Ej are defined as follows. So if the insured of Hx dies in the year J plus 1, at that moment, at the end of that year, there will be a payment Sj plus 1, and there is an expense Ej plus 1. The gross premiums Pj minus related expenses Pej is as follows. If the insured is still alive at time J, there will be a premium payment Pj and an expense Ej. So let us now suppose that the policy is still in force T years after it has been started, and let us determine the gross policy value Vt as a function of Vt plus 1. The policy value basis for determining Vt and Vt plus 1 is as follows. We assume probabilities Qx plus j. We assume interest rates Ij in year j plus 1, and there are expenses Ej and Ej. Let us first have a look at the expression for the policy value Vt at time t. It is the actuarial value of future benefits minus the actuarial value of future premiums. So it is the person at time t now has Hx plus t. If he dies now in the year j plus 1, starting from year t, so in the year, in fact, t plus j plus 1, then there is a death benefit St plus j plus 1 and a related expense Et plus j plus 1. If the x, so that first part gives the actuarial value of the future benefits and related expenses minus the actuarial value of future premiums and related expenses. Well, if the insured of x plus t years old is still alive at time j, or better at time t plus j, then there is a premium Pt plus j, which is corrected for an expense Et plus j. So here, this policy value, the general formula is given here. Then we can derive a recursion between Vt and Vt plus 1. The proof is given in the book. See the book, page 235. And we find this recursion 7.7, which again has the same interpretation as always. Having arrived at time t, there must be an equality for each policy in force at time t between the available assets at time t plus 1 minus and the required assets at time t plus 1 minus. What will be the available assets at time t plus 1 minus? That's the left-hand side of the recursion. We have Vt at time t for each policy in force at time t. There is a premium added Pt, but a withdrawal of the expense Et. This total amount is accumulated by the interest It, and this amount, so this left-hand side is the available assets at time t plus 1 minus, and this must be equal to the right-hand side, which is the required assets at time t plus 1 minus. Indeed, the right-hand side is the expected assets, required assets at time t plus 1 minus is qx plus t, is the probability that the x plus t year old person dies. Then there is a payment st plus 1 plus expense et plus 1, plus for the survivors, px plus t is the probability of surviving. For each of them, we have to set vt plus 1. So the right-hand side of this recursion is indeed the required assets at time t plus 1 minus. And the recursion, the backward recursion, so that means the way how we can calculate vt from vt plus 1, this backward recursion is in fact very easy to interpret as equality between available assets and required assets at time t plus 1 minus. Now we define the sum at risk for this general contract. This is also called the debt strain at risk or the net amount at risk. What is the sum amount at what is the sum at risk at time t plus 1? We define the sum at risk at time t plus 1, we denote it by dt plus 1, and it is in fact what is needed for the dyers at time t plus 1 minus what is needed for the survivors. Well, for all the dyers, we have to pay st plus 1, the death benefit, plus the related expense, minus what is needed for the survivors. For the survivors, we have to set up the policy value vt plus 1. And if we then look at recursion 7.7, where we take into account that a survival probability is 1 minus a death probability, we can rewrite the recursion for the policy values in the following way. Vt plus pt minus et multiplied by 1 plus it, so that's the available assets at time t plus 1 minus, must be equal to vt plus 1 plus dt plus 1 multiplied by qx plus t. What is the interpretation here of the right-hand side? For the right-hand side, what do we require at time t plus 1 minus? We require vt plus 1 for everyone. Remember, before we always said vt plus 1 is only for the survivors. Let us now say, in the first stage, we reserve vt plus 1 for everyone, everybody surviving or not. But for all the ones who die, we need then st plus 1 plus et plus 1, but there is already vt plus 1, so minus vt plus 1. So saying that we need st plus 1 plus et plus 1 for the dyers and vt plus 1 for the survivors is in fact the same as saying we need vt plus 1 for everyone, but for the dyers we need in addition st plus 1 plus et plus 1 minus vt plus 1. That means in the end, again, that there will be vt plus 1 for the survivors and dt plus 1 for the dyers. Okay, let us now have a look at a special case, a pure savings contract. What is a pure savings contract? That is a contract where by definition the sum at risk is always equal to 0. So dt plus 1 is 0. What does that mean, dt plus 1 is 0? That means that this is a contract where the death benefit and the related expense that is paid in case the insured dies in the year dt plus 1 is exactly equal to the policy value that will be available at time t plus 1. So at any time, if the insured dies, he just gets the policy value, or better, a little bit less than the policy value, because there is also the expense related to this payment. So if this happens, dt plus 1 is equal to 0, and this second part of the right-hand side of this equation disappears. And if you then look at 7.8, we can write it as follows. Vt plus 1 is Vt plus Pt minus Et multiplied by 1 plus It. So that's a pure savings account. That's the dynamics of a savings account, a pure savings account with the bank. If you have Vt on your savings account, you add a premium Pt on that savings account, and the bank charges a cost Et, but gives you an interest It, then at time t plus 1, Vt plus 1 will be on your account. So again, summarizing, if dt plus 1 is 0, meaning that the death benefit plus the related expense is always equal to the policy value that will be available, then in fact we do not really have an insurance contract, we have a pure savings contract. We can then, for this contract, also define the savings premium, and the savings premium is in fact the premium that you have to pay, the amount that you have to pay to bring the policy value from level VT to level VT plus 1. What is then a risk premium? The risk premium is the premium that is needed. That's in fact a one-year term insurance, the cost of a one-year term insurance that pays you DT plus 1 at the end of the year. So the cost of this one-year term insurance that pays DT plus 1 is QX plus T multiplied by V multiplied by DT plus 1. If we then look at 7.8, we find that the premium that is paid at time T minus the related expense is the sum of the savings premium and the risk premium. What does that mean? In fact, in any premium payment minus related expense, there is two parts. The first part is the savings premium, that is the premium that is needed to bring your policy value from level VT to VT plus 1. But there is an extra part, namely the risk premium, because the people, the insureds who are going to die, do not need the policy value at time T plus 1, but need the death benefit and the related expense. And that's this risk premium is the cost for that. And a special case, if we have a pure savings contract, then DT plus 1 is 0. If DT plus 1 is 0, then here we see that the risk premium is 0, and the savings and PT minus ET is then equal to the savings premium. Again, we see here, if we have a pure savings contract, indeed, the whole premium minus related expense is used to update the policy value, to bring the policy value from VT to VT plus 1. That's indeed a pure savings account as in a bank. Now, let us have a look at a slightly more general contract. This contract is not in the book. It's not considered in the book. So what we do here, there are death benefits, just as in the general contract that we have defined some slides ago, a death benefit of SJ plus 1 and a related expense EJ plus 1 in case the insured dies in the year JJ plus 1, but there is also a survival benefit involved. In the general contract that we considered so far, there were no survival benefits. So what is a survival benefit? If the insured of age X is still alive in J years, there will be a survival benefit LJ plus 1, and there is a related expense FJ plus 1. And then there is also lifelong premium payment. If the insured is still alive at time J, there is a premium PJ and a related expense EJ. Let us now suppose, now we do the exercise as the same as for the general contract that we considered before. We suppose that the policy is still in force after T years, and we want to determine the gross policy value VT in terms of VT plus 1. And we have a policy value basis for determining VT and VT plus 1. We have to specify what are the probabilities that we are going to use, survival probabilities or death probabilities, what are the interest rates, and what are the expenses. And they are all expressed here. What is now the policy value at time T? By definition, it's the actuarial value of future benefits minus the actuarial value of future premiums. So that is the actuarial value of the future death benefits plus the actuarial value of the future survival benefits minus the actuarial value of future premiums, and all these actuarial values, of course, corrected for the related expenses. Then you can prove that the following recursion holds, and this recursion follows from this general expression for VT. You can prove again that seen from time T, for each policy in force at time T, what has to hold at time T plus 1 minus? There has to be an equality between what will be available, the assets that will be available, and the assets that will be required. What is available is always the same as before. VT plus PT minus ET, this policy value plus premium minus expense accumulated by interest IT, is the expected required assets QX plus T multiplied by the death benefit and related expenses, plus PX plus T multiplied by the survival benefit and related expenses. And for the survivors, we do not only have to give LT plus 1, but there is also, we have to set aside the policy value VT plus 1. Again, available assets at time T plus 1 minus must be equal to required assets at time T plus 1 minus. And now for this general contract, we can again define the sum at risk. the sum at risk is what have to be paid to the dyers minus what have to be set aside for the survivors. So dt plus 1 is all the people who die in the year tt plus 1 have to receive st plus 1 plus an expense et plus 1 minus for the survivors, we have to pay them lt plus 1, there is an expense ft plus 1, and we have to set aside the policy value vt plus 1. That's now our definition of the sum at risk. We can then rewrite our recursion for policy values that we have seen on the previous slide in the following way. The available assets at time t plus 1 minus is, now for everyone, we give lt plus 1 plus ft plus 1 plus vt plus 1. So that's for everyone, not only for the survivors, but for the dyers, for the one who dies, then we need the amount dt plus 1, namely st plus 1 plus et plus 1 minus lt plus 1 plus ft plus 1 plus vt plus 1. If this first part is for everyone, then for the dyers we do not need st plus 1 plus et plus 1, but only st plus 1 plus et plus 1 minus this correction. So in the end, that means indeed that on the right hand side, this is what is required at time t plus 1. What is the expectation of what is required at time t plus 1? And then again, we can look at some special cases. A pure savings contract, there tt plus 1 is 0. And if dt plus 1 is 0, this part in the equation disappears. And the policyholder's account grows at the savings, just as a savings account with interest IT. Let us now have a look at a pure survival contract. What is a pure survival contract? That is a contract where there are no death benefits. So that means st plus 1 plus et plus 1 is 0. If st plus 1 plus et plus 1 is 0, that means that dt plus 1 is negative. So the sum at risk is negative. If the sum at risk is negative, the risk premium is negative, and that means that the policyholder's account will grow with an interest which is faster than the interest IT. So grows as faster than a savings account with interest IT. Why is that? Because now there are no, it's a pure survival contract, there are no death benefits, so everybody pays premiums, but the people who die on the way during the premium payment period, they don't receive anything. So that's the reason why a pure survival contract accumulates, grows faster than with the interest IT. For this more general savings contract, we can then also define the savings premium. The savings premium is now the premium needed to bring the policy value VT to the level VT plus 1 and the related payments to the survivors at time T plus 1, LT plus 1 plus related expense VT plus 1. The risk premium is then defined as the premium for a pure endowed, the premium for a term insurance of 1 year that pays the sum at risk at the end of the year. And with savings premium and risk premium defined like this, we can decompose the premium payment at time t minus related expense, pt minus et, is a sum of a savings premium and a risk premium. So if in an insurance contract you pay a premium pt and there is a cost et, well, this pt minus et is used for two parts: for saving, for letting your policy value grow, but also for the debt cover. And then we can consider two special cases: a pure savings contract. In a pure savings contract, the risk premium is 0 and the savings premium is equal to the whole premium minus the related expense. And we can also consider a pure survival contract where the risk premium is negative. And if the risk premium is negative, means that the savings premium is more than PT minus. Let us now have a look at example 7.7. Let us consider the contract with the following benefit cash flow. It's a pure endowment on a person of age 50 for a duration of 20 years. If the person of age 50 is still alive at age 70, he will receive 700,000. But if the person dies before he reaches the age 70, then he will receive he will receive the policy value that was available in the beginning of his year of death. To express it in formulas, if the 50-year-old person dies with a deferral period of J years, so if he dies in the year J plus 1, then he will receive the policy value of the beginning of that year, J. And the premiums of that contract are paid for 20 years with the constant premiums are paid for 20 years upon survival of the insured, of course, and the premium is 23,500. The question now is determine the policy value at time 50. For this contract, let us determine the policy value at time 50. The policy value basis, we choose an interest of 3.5% and the standard select survival model. And now we set up our expression for the policy value. V15 is, well, if the insured is still alive at time 15, he has the age 65, and his contract is now a pure endowment on a person of age 65, which pays in 5 years the amount of 700,000, provided he is still alive then. But there are also death benefits related. If the insured, who is now 65, dies with a deferral of J years, so if he dies between age 65 plus J and 65 plus J plus 1, where J goes from 0 to 4, he will receive V15 plus J. So this part here is the actuarial value of the future death benefits. And then, of course, there is also minus the actuarial value of future premiums that still have to be paid. So this is our general expression following from the definition of a policy value as a prospective value calculating actuarial value of future benefits minus actuarial value of future premiums. There is now a problem here because we have to calculate the policy value at V15, but if we want to calculate that policy value, we need the policy values, or the policy value at time 15 is function of the policy value at time 16, 17, 18, 19, and 20. So we cannot directly calculate the policy value here. What is the solution? How can we solve this problem? Very easily. We are in the section on recursive formula for policy values. So we will calculate this policy value for this policy in a recursive way. We will start with the policy value at at time 20, then at time 19, then at time 17, and so on. That is what we will do on the next slide. So what is the policy value at time 20? If we have arrived at time 20, then the policy value is 700,000 because we have to pay 700,000 immediately. What is then the policy value at time 19? Well, we know that V19 plus the premium accumulated by interest, that is what is available at time 20, must be equal to the expected value of what is required. Well, what is this expected value of what is required? It's Q69 multiplied by V19, because if a person of age 69 dies in the next year, we will have to pay him the policy value of the beginning of that year, V19, plus for the survivors, if the person of age 69 survives, we pay 700,000. Now we have here an expression where V19 appears in the left-hand side and in the right-hand side, because what will be available is a function of V19. What is required is also a function of V19, but we can solve this for V19 and find the policy value at time 19. And then we can do the same methodology to calculate the policy value at time 18. We write down the recursion between the policy value at time 18 and the policy value at time 19, and then we can solve for V18. And we can do this for the different times, V17, 16, and 15, and in the end, we can calculate the policy value at age 15. Last part of this video, let us now have a look at the analysis of surplus. So the insurer will make some kind of gain or loss on the assumptions that he has made in every year. Every year you have made assumptions on interest, mortality, and expenses, and what the real interest, mortality, and expenses can be different from what you have assumed, and that will lead to gains or losses. Let's have a look at this. So we consider a portfolio of the more general contracts that we have defined some slides ago, and we assume that they are underwritten to a group of insurers of age X. The recursion for the policy values is as follows. So we have VT plus 1, and we calculate them with the same basis, and we find the policy value at time t VT plus the premium minus related expense accumulated by interest, or the available assets at time t plus 1 minus, is equal to the required assets. The required assets is probability that the insured dies, then we need ST plus 1 plus ET plus 1, plus the probability that the insured survives, then we need LT plus 1 plus FT plus 1, and we have to set aside VT plus 1. How can we interpret this recursion? Well, as follows. Suppose that at time t, the insurer sets aside VT for each surviving policy, for each policy still in force at time t. Okay. And suppose that the experience in year t plus 1 follows the policy value basis. So we assume that in the year tt plus 1, interest, mortality, and expenses are exactly as we have assumed in the policy value basis. Then at time t plus 1 minus, the insurer will have the exact amount of funds. So this left-hand side is what we will have, what is available. That will be exactly enough needed to pay the death benefits and related expenses to all insureds who died in the past years, to pay the survival benefits and related expenses to all the survivors, and to set up the policy value VT plus 1 for all survivors. So this equality, this recursion that we have set up, implicitly assumes that the policy values, that VT and VT plus 1 are calculated with the same policy value basis, and that experience is exactly as in the policy value basis. Of course, in reality, in practice, this will never occur. In practice, experience, interest, mortality, and expenses in year t plus 1 will usually be different from the ones assumed in the policy value basis. So what will be available at time t plus 1 minus is VT plus PT, this is fixed. But the expense is the experienced expense multiplied by the accumulation factor based on the interest IT. Experienced is the experienced interest rate. So that is what will be available. What will be required? What is for all the people who died? So this is the experienced mortality in the year TT plus 1. For them, we need ST plus 1 plus an expense, and this expense that we needed can be different from the ones that we assumed. For all the people who survives, and this is the experienced survival probability, we need to pay them LT plus 1, that is fixed, but there was an expense FT plus 1, which could be different from the one that we assumed, and we have to set up the policy value. So this is what is required. So in general, the left-hand side, what will be available, will not be equal anymore to what is required. And therefore, due to that, or this causes that there is profit or loss occurs in the year TT plus 1. For instance, if the experienced expenses are smaller than the assumed expenses, okay, what will happen then? Then this, what will be available here, will be more, because the experienced expenses are lower. So the available assets will increase. And here, the experienced expenses are lower. That means we will need less. So that means experienced expenses smaller than assumed expenses lead to a profit. Experienced interest smaller than assumed interest leads to a loss. Why is that? Well, if the interest here, the experienced interest is smaller than the one that we assumed, what will be available will be less than what we required. So there will be a loss. The experienced mortality is smaller than assumed mortality. Will this lead to a profit or a loss? That's a little bit more complex to answer the question. Why? if the experienced mortality is smaller than what we assumed, this first part, the experienced mortality is smaller, so this first part is smaller. So we need less related concerning the death benefits. But if the experienced mortality is smaller, that means that survival is larger. So that means the experienced survival probability is larger. So we will need more of this for the survivors. So again, if people die, if experienced mortality is smaller than assumed mortality, this part is a gain part because we need less death benefits, but this part is a loss part because we need more for the survivors. So do we in the end have a loss or a profit? That's difficult. You cannot say something in general. It depends on the magnitude of this factor, ST plus 1 plus CT plus 1, and this factor. So depending on how large is the death benefit compared to the survival benefit, it will lead to a profit or a loss. So this is the end of video 3 on policy values. Thank you for your attention.